Ladies and gentlemen, thank you for chiming in today. I am extremely excited because today we are announcing the newest member to MLO, Mr. Christian Kemp. Thank you, Christian, for being here today.
Thank you, Edison. I appreciate the opportunity to work with you guys. This is an awesome new platform, and totally stoked to go ahead and help out our clients and educate them and have this digital platform to push it out there with. Thank you.
Oh, my pleasure. And just so everybody knows, like, Christian brings decades of experience, and he brings decades of experience. He brings quite a few AKA nicknames. So, AKA Mortgage Guru, AKA CK for initials, AKA Kempers. I'm sure there's some intoxicated ones in there I'm not aware of either.
I can't wait to get to the first tee box and have that being announced when I get up there next time,
Yeah, no, for real. No, man, I know Christian really well, and a couple of things I respect about Christian is just like the experience, but what comes with that is you've been through so many different market environments in real estate. So being a loan officer, you know what to expect. You've seen guidelines tighten, open up, crash, not crash, booming markets, down markets. I mean, a pandemic market is a first for everyone. But that being said, it's huge because right now, Christian, a lot of people are really reaching out. We saw about 60 days ago a 400% increase in refi applications nationally. And one of the things we wanted to touch on today for the consumer is, and I break this down all the time. I know you do. And this is why I wanted you to talk. Just because the rate's lower doesn't always mean it's a benefit in the long run for the consumer. So diving on that note, Christian, what are your initial thoughts in educating our audience regarding is refinancing right and what are things to look for,
Yeah, Addison, that's a great question. In this environment that we're in right now where rates are really low, most of the time it's going to be a right time for people depending on a couple different factors. Are they going to be selling their home in the next few years? Are they planning this house to be their forever home? So there's a lot of different things that you want to take in consideration. But mainly what we want to look at is like some of the break-even points, target interest rates that's going to get you to that benefit point. And so what we do is we actually will work up an amortization table and show them the exact date when that's going to break even and if it makes sense. A lot of times it's, even out of this kind of rate environment, we're looking at, people have to refinance for so many different reasons out there. And that's why it's important to kind of use your mortgage advisor yearly or semi-annual to kind of talk about what's happening in your life. Is it a new child, college? It could be retirement. There's a lot of different reasons to refinance. Is it going to be to do a big purchase, a second home, investment property? So I think for as far as refinances, it's always going to be there. Everybody's going to need it, using their number one asset to help them achieve some additional goals.
Yeah, and I think bringing it back, you made some really good points there, Christian, and to kind of rally it back home, like biggest word you brought to me is break even. So if we're going back to what you just, we always like to break this down to like distilling it down to, what the person that doesn't talk about this all day, something that they might be able to understand and take home. So like, when you are refinancing, and chime in here, like you've got your current balance on the house. So it's something that you owe right now. But then what's not talked about and explained to consumers enough, in my opinion, is what the new loan amount is and what's associated with that. So give me a little bit more. Let's talk about that and then go to the break even.
Yeah.
So hit me with that breakdown.
Yeah. So a lot of people will ask for a quote and what are closing costs? What is the new interest rates? They're going to make a decision. Am I going to roll these closing costs into my new loan? What is my new loan amount going to look like? And if I do come out of my pocket, what is that break-even point with the monthly savings or the
Mm-hmm.
APR or whatever it may be that they're trying to achieve. And we take in a couple different indicators too, like debt consolidation, what,
Mm-hmm.
some additional savings, but a true rate and term, yes, we want to
Yeah.
go ahead and find out what that savings is, how many years left they have on their current mortgage,
Yeah.
um, and take that away and kind of see the true value point of where that's going to break even at. And we can, do that with the amortization tables, taking their current loan
Yep.
and seeing exactly where that's at. And kind of rule of thumb, everybody says 2 years is the rule of thumb. I don't know where they got that, 2 years to break even. And I think that's just because the average consumer probably refinances their home or sells their home every 5 to 7 years, or
Yeah.
does something, change to their mortgage. And so we want to take that in consideration what the average is of when
Yep.
that's going to be. And that's just talking to your client and finding out what exactly is going on in their life, what's in the future. I know that we don't have a crystal ball, but if we can kind of drill it down to some of those short-term goals and then come out with some analytics of it, I
Yep.
mean, it's pretty easy decision on, does it make sense?
Yeah, no, that's really well put. And hey, I want to. We've got an audience question here in the comments. When you skip, do you skip a payment when you refinance, like when you purchase a home? And thank you, Mr. Will Murphy, for chiming in early with the answer of yes.
Yes.
Huge applause for Mr. Murphy chiming in. Wow.
Thanks, Mr. Murphy, for that question.
Yeah,
Well, when
no,
we're
Will Murphy gave the answer.
Well,
Christian asked
I
it.
want I want to kind of chime in there a little bit. Yes, through recordings and everything else on your new mortgage, you typically will skip at least one mortgage payment through that transaction, and we kind of use that in our analysis. If we're going to be putting that back down on a refinance when you get that first payment, are we going to add that towards the principal? And we can kind of show you how that looks with getting your escrow back. And I know I'm talking about a lot of different terms, but typically most clients will have an escrow account with their taxes and insurance in it, and we are typically setting up a new account for them when they do a refinance. So within 30 days of closing their transaction, they're typically going to get some funds back from their current lender. So we come up with a strategy. Are we going to pay off some debt with that? Are we going to put it back towards the principal? So there's a lot of different things that we can do of talking about how we can show that savings in a shorter term.
Okay, yeah, okay,
I know that's
man.
kind of going totally
No,
off script there, but
no,
that's something that we can talk to each one of our clients, separately about.
no, it's super awesome. I think, bringing it back to just general stuff, like, do you skip
Yeah.
a payment to buy? Yes. And I
Yep.
often use that entire, the analogy of you're essentially buying the house from yourself again. So there's an amount out on it. It gets paid off. You got a new one. So
For sure.
yes, you do skip. And one note, because I want to get back to the breakdown of the costs. That was the original thing. But that being said, closing date also is a very big strategy within refinance because it will dictate when your next payment is due. So Christian, in short, could you explain, say we're closing on the 30th, right?
Yep. So if we're closing
You
on the
will,
30th, yeah,
uh-huh,
you're going to have 1 day of prepaid interest typically on your closing disclosure, so that
right,
we're only collecting 1 day interest for the new loan.
yep,
And then, yeah, you're going to have 1 month where it's going to be recording, and then it would start, let's say, instance it closes in May 30th. You wouldn't have a payment in June. Your first payment would be July 1st with a 15-day grace period.
right. So if you close, yeah, that's a great end of month. So if you were to maybe close the first week of the
Sure.
following month, you might actually have 7 to 8 weeks until your next payment. So to back that comment and Will Murphy's answer too, in some situations, you could have 7 to 8 weeks before you have a new payment actually invoiced.
That's correct. Typically, we are getting your payoff from your current mortgage that includes interest to our close date. So instead of paying principal and interest that month to your mortgage, your current mortgagee,
Yep.
we'd be just collecting the interest through the payoff and paying off that month's mortgage through that. So that's how you actually skip. Some loan obviously skip 2 months mortgages, but actually you're just skipping paying the principal. We're just collecting the interest for that month through the payoff.
Yep. Okay, I love it. I love it. I love it. Any more questions? Just guys, feel free. Don't be shy.
Yeah.
We're all family and community here. No one's trying to sell you anything. We're just trying to give you the straight up answers transparently, which is a big part of the foundations here at MLO, Modern Loan Officer, which we do all of our podcast live streaming here. We're on Apple, Spotify, and iHeart Podcasts. So go on there, subscribe, so you get notified for every new episode. We're cranking them out once and twice a week, and some really, really great stuff. Like the new construction one with Casey Carpenter was a big smasher. And yeah, keep updated on those ends. So going back really quick, and I got Will Murphy chiming in with another question. I don't want to steer too far away from the costs of refinancing. When is the worst time to close? When is the best time to close? Time of the month? I know. I'll just like straight up. I think it goes back to what your goals are in the mortgage strategy. Closing at the end of the month. Obviously, you skip that one payment that we just talked about, but closing out of the earlier month might give you a little more spread. However, you do pay what is referred to as prepaid interest, sufficing to the end of the current month when you hit that closing date, which generally speaking, it depends on the loan amount. You're looking at $30 to $45 per day of prepaid interest. So, and to answer Murphy's question, it kind of depends on the goal. Are you trying to reduce the amount of things financed in your loan that you will be paying interest on over the next 30 years? Or are you really just trying to patch up a hole in the boat and liquidize as much as you can, reduce your overhead, and cushion up your savings account? Anything to add on that, Kemp?
No, it's great points. I think it really doesn't matter. I mean, the prepaid interest days are going to be what they are. It really depends on if you want to make your mortgage payment in the beginning of the month and avoid, the late payment after the 15th. So yes, I'd say, if you could fund your loan before the 15th, so you avoid a late payment, do it. If not, go ahead and make your payment and you'll get a refund back from your current lender.
Yeah, good point on that one.
Yeah.
The 15th's a big deal, guys, to everyone out there to know, because like everyone, most people pay their mortgage the first, second, or third couple, of the month, but you actually do have that grace period without it hitting your credit and showing up as a late to the 14th or the 15th. So that is really
well. Actually, it won't hit your credit until the 30 once you're 30 days late, but you will get a penalty from your current lender for having a late payment after the 15th. It's usually
that's a good
5% of your current mortgage payment. So
and don't
not a late yeah.
Don't mess with that though. I mean, it's just not worth the risk. If you got any questions on it, communicate with your servicer and your loan officer. And Mr. Murphy's just coming to town with the cues. I love it. So let me say, when is the worst time? We covered that. When is the best time? So we covered that. Are the costs of refinancing comparable lender to lender? And this is what I really want to talk about.
That is a big question for everybody.
Dude, everyone, like, what are the costs? And what pisses me off is when you talk to an officer and it's like, whoa, and you get a bunch of jargon BS about what the costs are. So one question I get a lot in Kempers, I'm going to lean on you to really dive in a little bit here, mainly because here we both get different questions, different demographics, different clients. Question I've been hearing a lot is, what's your origination fee? And I think that's a really confusing term for consumers because not every lender has an origination fee. There's costs associated with the loan that your lender will cost to do the transaction. So sometimes they're flat rate and sometimes they're a percentage of the loan, which is referred to then as an origination fee. Please cut me off, CK.
No, I think, I'm going to date myself a little bit of being I think it's April. It's 17 years. In 2003, I got into the business, and we called it an origination fee. It was like the upfront costs, everything included. It was all considered origination fee, and it was a tax deductible as long as in the origination fee. But those terms have changed a little bit. Now we have a processing fee and an underwriting fee that's kind of taken out of that origination fee, and those are things that are going to be different from lender to lender. But origination fee is going to be a lender fee. Some lenders will charge a 1% lender fee or origination fee on all their loans. It's a 1% of what your loan amount is, or a 0.5%. and it's not a bona fide discount rate, which a bona fide discount rate, we can go into it a little bit more, is actually buying down your rates. So that used to be all lumped up into one, totally different now. So origination is what the lender is charging you to do their loan. You can maybe call that a processing and underwriting if they don't put that on there, but that's how we kind of done it in the past. And what you really want to be shopping is the bona fide discount rate to get the current interest rate that they are either providing you or shopping you.
Yeah, and to bring that back, guys, bring it back to someone that doesn't do this all day long. So you're going to want to know just what and origination is fine, but what are the loan associated costs from the lender directly? Like we are flat $15.90 processing underwriting fee, no matter what. It's not a percentage. It's not this. It's not that. So the hard costs though, which I don't think loan officers communicate enough, are uncontrollable costs on our side as loan officers. So examples being, you are all those fees that you had again when you bought the house, you have them again on the refinance. So your title, county, transfer, title insurance, all of that crap, the prepaid escrow deposits, you're doing that over again, guys. So a couple things to note: lenders don't judge what those costs are. So typically those hard costs are gonna like roughly be around $3,000 for your kind of like your hard title, county, appraisal, all that stuff. And we're going to get into appraisals and who needs them and who doesn't later in the show. But you're looking at two different buckets on the total cost. So you've got your title ones, and then you've got a brand new escrow, which Kemper's talked about earlier, which is a brand new escrow account, the prepaids, which includes the prepaid interest, but also, depending on the state you're in and how often you pay, almost a full year taxes and insurance again. One thing to note, you get the balance of your current escrow back from the servicer of your mortgage in the form of a check. That takes like 3 to 6 weeks, depending on the servicer, but super, super important to know. And bringing it back too. So you've got the amount owed on your current house plus the total costs of the new one combined gives you your new refinanced loan, your new loan amount. So I really want to make sure we hit that for Mr. Murphy.
I want to hit on that as well real quick.
Aware. You want to take this one, Kemps?
Yeah. Should consumers be aware of any cost refinance that maybe aren't obvious? I think that origination fee is a huge one in there. What is the lender charging? Make sure we can go into APR a little bit, but that's a real true way to shop your lender. What is the APR at the end of the day? It's lumping all those costs into one and coming out with a total APR. So if you have a lock-in rate of 3.375 today, and your APR is 3.45 with me, and you get the same rate from lender B that has the same rate as 3.375, and the APR is at 3.625, that means that there's additional fees that are in there for the same rates. And that's a good way for a consumer to shop. One lender to another is shop the APR. It's going to give you the true cost on there, and whoever's going to be the lowest is the one that's showing the least amount of total fees.
Yeah. No, I love it. And Murphy's just cranking out these awesome questions. I'm going to bring in, we've got more to address here, guys. I'm going to bring in our VA team member, Casey Carpenter. So if there's any vets watching too, that's what's great about Casey. We do a ton of VA loans, and the veterans have some unique advantages to take. How do I say that without saying advantage again? Have some unique opportunities to take advantage of. So let's bring in Casey. Hey, Casey, welcome to the show, man. I know you've been busy helping clients and you've been cranking. We've got a good show, so thanks for taking the time. Let's see. We've got another one. Mr. Murphy's taking the stage really quick. What are rate floats? So, yeah, great question, because there's a huge difference between a locked rate and a floating rate, and every lender is going to have different rollouts on how that they're going to lock your rate and why. So, I want to. Oh, let me just explain, right? Locked means it's good. Like, usually the locks are going to pertain for a certain amount of days. Pretty much standard is 30 days. So when you're working with your lender and they say your rate's locked, you're good to go. Your rate can't change. So a question I get all the time, well, what happens if my rate goes down? The interest rates go down and it's locked at like 3.5 and it goes down to 3.375. Do I get the better rate? Now, in former markets, there used to be company thresholds to honor a lowered rate, but now with where the market swung, those are gone, dude. I haven't even met one or talked to one consumer of you guys that are still honoring a float down. I don't think so.
No, I haven't seen anybody.
Anyone chime in? Bueller.
Yeah. Unless it's I've seen it honestly at some of the bank levels, but who knows? I mean, things are changing per month right now per policy, so y'all are seeing a lot of those little things go out the window.
Yeah,
and
for sure.
And I think the margins were so crazy that you'd have to see 150 basis points for it to even make sense for it to happen. So I think it's kind of a moot point at this time. With a float, what we're trying to do is position yourself in the best form to get the best interest rate at the best certain time. So that may mean that we're getting you through the underwriting process and getting all the goods together so that we can get even a shorter term, a 15-day lock or something a little bit better in pricing. So each individual, we're going to have our own strategy. Every person's going to gamble a little bit different. With a purchase versus refinance, it's going to be different as well. But floating just means that your rate is floating. The day that you lock is what the term is, and the rate and the term is.
Yeah, for sure. And I think one thing to know too is you definitely want to communicate, because every lender's got a different flow to how, like, I don't want to dive too deep into it, but our strategy as a company is submitting the loan, getting it through processing, and then locking the rate, primarily because that takes less days on the lock. So say a lender's closing refinances in 60 days, a 60-day lock is worse pricing than a 30-day lock, because you're securing in that term for much longer. So if you can get a lot of the upfront work, get with your loan officer, get into underwriting, get through all that crud that is boring, whatever, and then lock the rate, you're going to typically get a better interest rate. I want to go to some of these comments again. My wife I love her to death, just chiming in. Love that Christian's on the team. We love you, Chris.
Thank you.
And she's been a huge advocate for the team here, project managing a lot of this back end stuff for us with the streaming, the content, and managing, getting all of our social media stuff, because we're all super busy taking care of our clients. So thank you, my lovely wife, Kristen.
Thank you, Kristen.
Also had a really good cue here. Do all lenders truly have the best interest in mind when trying to refinance? How do you know if it's actually worth the cost? And I think that's worth reiterating. So CK, aka Mortgage Guru, would you mind kind of taking that one for us?
Yeah, definitely. I've consulted with many of my clients, and it just, sometimes it just doesn't, pencil out, or it's just not the right timing. So what we typically will do is set some thresholds of where that, even point is, or where it makes sense. And what we do, we put it into our calendar. We have rates watches for them, and we're keeping them educated. And things may change during that process where it may make sense, or they may not need it down the road. But I think some loan officers may just say, yeah, I can save you $50 a month, but does that really make sense down the road? Probably not. Not on maybe on a $60,000 loan that might make sense, but does that make sense on an $800,000 loan? No, probably not, with the fees, long term, what you're losing on the time that you have on your current mortgage. So I'm hoping that lenders are out there doing the right things and going through the same process that the MLO loan officer does. But that's why it's so important to pick a true advisor and treat them just like your insurance guy. Meet with them once a year so you can discuss, are there any changes? Do you have a big purchase coming up? We need to be able to help you be strategic in your next big purchase or refinance or saving for college, retirement, whatever it may be. So I think it's different with everybody.
Yeah, and hey, really well said. I've got so much. This is a good episode rolling here, guys. And I want to bring in Casey too, and Casey from a veteran standpoint, because I hear a lot of people, like I have a lot of veteran clients that have done purchases and refinances with me. Veterans get hit all the time with like solicitation calls to refinance. And from what I've heard, man, is like they get them on the phone, they try to get them to do the credit pull, tell them that they're going to save X amount. Like, could you give, as a veteran, like, why are the veterans getting hit with so many solicitation calls? And what are things that some of our veterans, shout out to our boy Ben, down in there. But yeah, Casey, chime in just briefly on the VA perspective and what things vets can look out for,
Yeah, and I really don't know what the target thing is. I mean, maybe they just assume like it's public information, or it's. I mean, I'd almost highly recommend it. That's where it's coming from. But really, from a target marketing standpoint, I have no idea. Maybe we're just nice guys after the service and we're easy to talk to. But honestly, though, veterans need to be aware because there's several different, lenders out there that focus on different loans, and there's actually a handful that focus on VA loans. You've probably, maybe come across a couple, but
right.
When you're being directly solicited like that, and I mean, I always am coming back like Christian was just touching on. It's that advisor, that relationship status that you're trying to have, and you might not, as a veteran or as a homeowner, sit there and have that with a mortgage person. So someone calls you and it's just like, oh, this could be interesting, and that does put you, I think, in a tough spot as a veteran or as any home buyer, honestly, because if you don't have a MLO advisor for you here to help you and answer kind of some of those questions or talk to, you're trying to make those decisions on your own. And then it's just, really, is it something that's benefiting you? So, yeah, I mean, is a lender offering a competitive rate for that veteran? Because the VA rates are great, so they might be, saying how much they can save them, but at the end of the day, they're offering a higher rate, which isn't even the best advantage for that veteran.
Yeah, and I'm gonna hop in really quick because like the questions are just piling up here. And Casey, I think you're right. You got to watch out who you're working for, because one note, I was working with my client on the phone because he's like, oh, so and so said that I could save $200 a month, right? And I'm looking at that. I know the file pretty well. This guy's not only become a friend over the years, but I've done multiple loans for him as a veteran. And I'm thinking through, I was like, oh, you're at this rate. I know that for a fact because I did the last one. And I know where the rates are at right now. That's not really penciling out. And I'm talking to him on the phone like this. And this is why you work with someone you know and you trust. And it's like, okay, I see, a potential rate improvement of this amount, which could affect the payment by 100. And then we're chatting it through and it's like, oh, well, if I wanted to structure a quote to a client to demonstrate $100 more monthly savings, how would I do that? Okay, what I would do is cut the homeowner's insurance in half. So $85 a month now on my quote is $40 a month, which in turn also affects your closing costs and your loan amount. They might not even be counting for the new loan amount that we talked about as well, because you're financing it in. And then you could be pulling old freaking property taxes from the year prior. So it's unfortunate for like a 1-800, I'm not going to name them, but we all know the commercials, to call someone in a cubicle and to throw out a bunch of BS numbers, and the consumer's like, oh, $200 a month, when really it's like 94, and it's not that. They might want to wait, or they're going to move in 2 years. That person in the cubicle and on the phone doesn't give a crap about the veteran or the conventional loan and what the best interest is. So a couple of notes there on why to work with someone who who gives, I mean, it's hard. When I get pumped up, I really want to curse.
Yeah.
Live stream keeps me freaking honest. I want to go into a few. Murphy, I don't want to miss your tax question, but I will want to throw out here.
Murphy was throwing out some great questions.
Murphy's great. Matt, our boy Matt, doing refi with Christian and Addie was the best decision. Our wife, hey, Christian, I'll let you say thank you. Matt was awesome.
Thanks, Matt. Appreciate it, buddy.
Yeah,
anytime.
Well, thanks for commenting. We super appreciate it. A pleasure to work with, and I'm glad that we got you and your wife into some even more favorable terms, and it worked out for you. Going down to, I don't want to skip, but we've got other questions from other people, but let's hit Murphy one more time. CK in the house, you mentioned tax deductibility. Is this still in effect for any portion of the refinance? And let's try to condense the answers. You go CK, and then I've got a note about that on VA after you're done.
Yeah, I mean, I'm not going to be the one to say yes because I'm not a tax attorney. You know,
yeah, we're not attorneys. We have to say that we're not licensed. Not
licensed CPAs, not licensed tax attorneys.
Yeah, I think it's still like if it's in that origination side of things, it is but the discount part is not tax deductible. And I could be wrong on that, but I think anything in the lender's loan origination box, that's how it's always been, was in the tax deductible side. But I think a lot of that has changed in the past. I don't think there's much tax benefits on the refinance side of things anymore. So check with your tax advisor. Bring in your closing disclosure when you go do your taxes the following year. There may be some items that are, but they will be the best person. So just take in what we call the closing disclosure when you do your taxes for the following year, that anytime you did a purchase or a refinance. And I know that TurboTax asks you and it prompts you for certain lines on that CD statement. So there might be a few items on there.
Right. And hey, if your CPA or tax advisor, gives you a couple nuggets, come back and share that with the mortgage advisor. Yeah. We get these questions all the time. You would not believe how many CPA and tax questions we do get.
And if we got any CPAs out there listening, chime in.
Oh, we got
chime in, because obviously we're not licensed. It's not, it's not our cup of tea to advise at all on any of that. So we are always open for that information because it comes up a lot in real estate.
Well, we do know that a portion of your interest is tax deductible on your primary residence and some of your second homes, and obviously investment properties. You have your own write-offs on that too.
So one thing I do want to know before we move to the next question regarding the tax returns is specific to veterans. If you have any sort of disability percentage, check with the county website. Mortgage lenders can't set this up when you're buying a house or refinancing it, but certain counties give significant discounts to veterans based on that disability, upwards to 100% relief, right, Casey?
Correct.
Dude, a lot of people don't know that, especially people moving here. So look with the county, whether it's Clackamas, Washington, Clarkup, whatever it is, look into it, because there's a lot of veterans out there right now that can reduce their required property taxes just because of their disability without needing a refinance. I swear to God, guys.
Yeah, that is a very, very true comment. Very true comment statement. All that.
I said it.
Of course it is. Of course it is. But you'd be surprised though, because a lot of veterans don't understand that too. And after you've closed the home, if you're in contract and stuff going through a purchase right now, you gotta wait till that home is closed and then reach out to that county. But it's a real savings, guys. I mean, it's a real savings.
Is it just a deferment program? Is that what it is, or
it's a tax relief?
Tax relief with your disability.
Kind of like what they do for like the seniors, that same type of thing. I know that goes on the back end.
That's a new topic right there. What do you got?
Let's dig into that on another episode for sure.
Yeah, we'll get on another episode, but it's the same. Like, hey, service members for our country get compensated for disability, and they shouldn't be taxed the same way. Especially it's what I love about the VA loan is it's designed for the veteran to win and have a very well manageable overhead, and they want to help out with that. Like someone giving up years of their life and in some instances, their physical capabilities on other things. So they're going to get a discount on their contribution to property taxes. Sure. So anyways, moving to the next one, guys. Matt. Oh, Kristen. Yeah. Thanks. Fab3. Boom. Thank you, honey. I love that she's chiming in. We go back to Matt here doing our. Oh no, we already did that. Here's this question: what are the benefits of paying down your principal faster? Oh yeah, buddy. Now we're talking spread. We might have to open up a third window on here with a spreadsheet share if we want to get really
Oh, I
nerdy.
know.
Us three are huge spreadsheets nerds. For example, paying an additional mortgage payment directly toward the principal each year. I don't want to steal the show, but I'm a huge fan of this. I will open up with letting CK roll, and then I've got a personal example as well as approach on it. So go ahead, Kemp.
Well, I love this question from Matt because we have spent time and efforts trying to come up with different ideas and ways to pay off his house sooner and to create more equity. I know that they're doing some remodel and different things, and they're just trying to find the best value and come up with different ideas. So I think everybody's goals are going to be different, like we've talked about. But yes, adding money towards principal each month is going to pay down your loan faster, which is going to shorten the length of the loan, which is going to mean that you're paying less interest. And that's the coolest thing about the mortgage part of things, is the numbers don't lie. Everything kind of calculates the same thing. It's so fun to kind of play with the numbers and say, hey, I really want to retire by this date. What is it going to take to do that? We can put it down to the dollar to get to that, to achieve that goal. So, yes, tons of benefit is by, cutting the interest that you're paying or shaving off years of your mortgage, and then having that extra equity at the end of the day when you do go to sell your house to put it down on the next future big purchase. So tons of benefits. Thanks for the question, Matt.
I think Addison. Yeah, to add into that, I think some just easy math. Let's do some round up easy math. So a really huge question I get all the time is well, what if I do a 15-year fix? Which there's a huge, obviously it's half the terms comparatively to a 30, right?
Right.
What I always like is looking at it as okay, a 30-year gives me the lower payment because it's spread out as twice as many years. However, I can always pay more to the principal every month or every year and cut off the years. So for example, personally on our primary mortgage, we pay about 1 month or one extra payment per year. So it's $300 extra a month that goes directly to principal, not the interest, directly to principal. And that shaves off the math that I did on our loan. It was 5.7 years. So if I were to make an extra payment every year for 24, 25 years, I would conclude my 30-year fix at that point. So I'm doing a 25-year fix manually, but I'm only being held to the lower payment minimum standards, which I think is a very important thing right now, because all those people that lost their jobs, but if you stop, your income doesn't come through. You want to be able to only make the minimum payment. And on a 15-year, that what is it? I'm sorry, guys. It's a lot more. It's not double, but you're looking.
You're getting close to it.
Well, it's about 2/3 of it. And it's funny you say that, Addison, because I'm seeing some of my 15-year clients now that the 30-year rate is so low, go back to a 30-year with the same mindset of still staying on plan of paying this thing off in 12 years. But the flexibility, in a time like this, it's huge. It's kind of like pick your payment. The minimum payment you're going to make is a 30-year.
Going back to those, huh?
I'm going to say the minimum payment you're going to make is a 30-year fix, right? That's the very least that you're going to make. Right. You can't get in trouble there. I mean,
pick your payment.
Yeah, but it gives you that opportunity, and people that are in a bonus income or commission income, it's great to have that flexibility to put down big chunks at it. And I think that's really where you see it. If you can put down, I get a bonus, a couple $1,000, put it down towards that, because, you're seeing that principal drop off right away. That's great that you're able to do $300 a month, but, if you could do some of those big chunks, you're going to see it, shave off faster.
There's one I'll touch in on that real quick, and then we can jump on to the next one. There's a strategy, and a lot of people, obviously everyone's got, there's different strategies, and everybody's got their own goals and mindset and kind of what they're working with. But clients, stuff that we would look at is what's called an equity position strategy. So you have your 30-year mortgage, right? And we always look at them, but it's a 30-year, and just think of it as like a bell curve, right? You start it, and 360 payments later, eventually we're at zero, right? We're starting at the top, and then we just curve back down to 0.
Mm-hmm.
But that's when you're making your regular payments, right? So like you're mentioning, Addie, you make your additional principal chunk per payment or whatever. So instead of you doing a natural bell curve on your normal payment, you're now doing a little stair step, right? Because each additional payment you're making is chunking down into that principal loan amount, right? It's paying it down. So instead of the curve, you're starting to stair step. Well, that equity growth then naturally at the top you have your house that appreciates, right? Well, I mean, we hope so. We hope our houses are appreciating, but your house appreciates, and then you have underneath. This is kind of hard to do as we're on the thing, but then you have this bell curve, right, of your loan. So as your house, appreciates your bell curve, but then you're starting to stair step. So you're creating a bigger gap there. Is really all I'm trying to picture. And at a certain point, then you go, how do we access that equity, right? Like we're getting there, but how do we access it?
You're losing me. I need a visual for bell curve.
Well, if you just
I think what you're trying to say is everything's interest front loaded, at the top.
Right.
Yeah. Your 30-year loan.
So what we're trying to do is we're trying to take a slice of that interest out of there by hitting the principal, because anytime you start a new loan, it's
well, yeah, and on your 30, right? When do we naturally start paying this thing off? Really, on that back half, right? Mm-hmm. That back half's getting. I mean, for the most part, that back half is where it's at. Well, what I get to is with those clients is at a certain point, like if you've been doing that for 5-10 years, you've created a good equity position. Now, what do you want to do? Do you want to do a cash out refinance and grab some of that? Do you want to change it up, or we're going to look at the terms? Or some people will then stick in a HELOC. Not that they're necessarily going to use it, but they're sticking it in there, and they might use it to then access that funds if they need to right away, and not change anything and keep them on their own path, like you're doing of 300, your extra payments and however you're doing it. But they have that in place though to access that equity if they do need it. They've created the gap, and now they can access it instantly with a HELOC if they wanted to. But again, there's multiple strategies. Maybe you do a cash out, you change your terms, we do that instead of HELOC, whatever it is. But you've created yourself now that equity gap quicker than you would naturally on paying your regular payment. Is all I was trying to get to, and I'm done. Out. Thank you. That's all I wanted to get through.
What a ride. I love it, guys. I think it kind of summarizes up to everybody watching too. It's like you need someone who cares. I mean, we spend a lot of time here. The number one thing on our team, MLO, is the fact that, guys, we're going to do what we can do to break down the numbers so you understand what you're getting at. And a lot of time we spend time with people explaining why it's not a good idea. And we just want everybody to get in the best position they possibly can and understand what they got going on, because there's so many different confusing ways to structure a loan. So going to the next one, can you use a different loan program when refinancing? Do all available programs apply? That's a really good question. Yeah, you can use different programs in hip hop. I'd say one thing to note that you might not qualify for a loan program that you originally signed up for, especially if it's like income restricted, which those are a lot of first-time home buyer programs getting out there. If you're income restricted, now you're exceeding that, you can't really take advantage of it. Anything else to add, guys, to try to keep it to a few sentences, because we're rolling. Like, this is a good episode. Anything to add? Bueller. What's I've got the crickets one.
There it is.
Nothing.
That's mine.
Nothing. All right. That's cool. Thank you.
I mean, I agree with what you said. That's it. I mean,
okay. I love it. I don't have a sound effect for that comment. Will Murphy throwing in a golf question. He knows we're all freaking golfers. When you're on the 18th tee box at a company golf scramble, you 3 plus Kristen, or on a team par 4, goggling left, pesky Penderosa. Why do I feel like I'm at Broadway golf course? Just before the fairway, entire green is surrounded by a moat. You just get one shot. Who's taking?
Wow, who's taking that shot?
Well, I know Addie's got the long drive.
I'm going for it. I'm your go-to.
Scramble.
I'm pretty squirrely on a tee off, though. You might not know what I connect.
Get one in the fairway, right? first. You got to get one in the fairway and a scramble.
Well,
Like,
that's why I'm going first.
I mean, I'll take it off the barn, the tree, every way I can get it.
I don't know,
I go first.
Christian, you're lethal with that 3-wood. I know, like we haven't played in a super long time because we've been really busy, but dude.
But a man that can hit a 3-wood is dangerous.
Dude, Christian, tried that 3-wood big time. We love you, Murphy. Thanks for participating.
Thanks, Will.
We got Emily says great information. Thanks, guys.
Oh, look at that. Thank you, my sweet wife.
It's
I appreciate that.
Reunion episode. Like everyone's showing the love. And I think, it's Christian's first live show. So this is a huge reunion. And once again, any more question, guys, really, in all seriousness, even if it's just about Portland loans, purchases, the market, what's going on out there, refinances, we're all here to help. And I love this comment. Once again, got to let the big dog eat. That's a reference to hitting golf, and I'll have to share that video we made years ago. But yeah, guys, it's been fantastic bringing Christian on, and we're going to do much more of this consistently. So we appreciate all the support. Once again, guys, MLO, you're listening to the live streaming podcast session with yours truly, Addie Net. Our newest member, Christian Kemp, aka CK, aka Mortgage Guru, aka Kempers, and our trusted loan officer and veteran, Casey Carpenter. Please log on, guys. We've got Apple Podcasts, Spotify, and iHeartRadio all cranking. I really appreciate everybody listening to those. And special news, guys. Can I get a drum roll? We are about a week away from launching our YouTube channel, so we will be. It's going to be big. It's going to be big. All right. Thanks so much,
guys.
everybody. And
thank you.
have a great day out there.